All right, let's jump right into this explainer. Today, we're putting Sunrun's Q1 2026 financial and operating results under the microscope. We really want to see exactly how the nation's leading home solar and storage company is navigating what's traditionally, well, their seasonally lightest quarter. We're going to look way beyond the surface-level headlines and dig into the actual nuts and bolts driving the business right now.
Think of today's deep dive as a sort of financial physical for Sunrun. We're totally skipping the fluff to give you the bottom line up front regarding their immediate health, their balance sheet, and their strategic roadmap for the rest of 2026. The big overarching question we need to answer today is this: how exactly does a major giant in the renewable sector handle a quarter that's marked by seasonal dips and some pretty complex shifts in project financing? Let's find out.
Okay, first big number you need to know, $1.1 billion. This represents Sunrun's aggregate subscriber value for the first quarter. Now, if you compare that to the same time last year, it's down about 13%. But context is everything, right? In the energy sector, and especially in residential solar, the first quarter of the year is historically the absolute slowest for volume. But as we unpack the data today, you'll actually see that this volume drop really isn't the whole story. It's heavily influenced by a very strategic shift in how they monetize their installations.
Now hold on, because here is the number that might just make you do a double take if you're quickly skimming the earnings release. A reported cash generation of negative $59 million. In literally any business, negative cash generation is going to flash a warning sign. But in the highly capitalized, massive-scale world of residential solar, taking a number like this at pure face value without looking at the underlying mechanics, that's a huge mistake.
Before anyone hits the panic button over that negative figure, CEO Mary Powell actually provided some absolutely vital context here. She pointed out that, sure, while this was the seasonally lightest quarter for volume, Sunrun still delivered incredibly strong unit economics. More importantly, she highlighted that a very specific shift in project finance timing into the second quarter is what primarily dragged down that cash generation number. So, it wasn't a sudden loss of fundamental business, it was really just a matter of when the cash actually changed hands.
And this is where the nuance in the cash flow becomes so crucial. If you look at this, it brilliantly illustrates why we always have to look a little deeper. When we exclude $28 million of strategic equipment, safe harbor investments, the pro forma cash generation is actually a much more manageable negative $31 million. So what exactly is a safe harbor investment? Basically, it's Sunrun proactively spending money right now to lock in future tax credits. They are strategically maximizing the investment tax credit for 2028, 2029, and 2030. It's a calculated, high-return investment for the future, not a day-to-day operating loss.
All right, let's move on to evaluate their financial moat with Section 2, Balance Sheet Strength. Okay, just look at this, $3.7 billion. That is a staggering number. This is their contracted net earning assets. To put that into perspective for you, after stripping out non-recourse debt, this is the present value of the cash flows Sunrun has already contractually locked in from its existing customer base. It translates to an extremely impressive $15.71 per share. This right here, this is the absolute bedrock of their valuation.
Now, to support those massive long-term earning assets, a company needs immediate liquidity. And as you can see, they currently hold roughly $680 million in unrestricted cash. When you combine that with the restricted cash of about $410 million, they're sitting on nearly $1.1 billion in total cash liquidity. That is a massive, massive buffer. It allows them to execute their strategy, manage those seasonal Q1 dips smoothly, and aggressively invest in future growth without breaking a sweat.
So, how are they planning to deploy all of this? Let's look at their capital allocation strategy.
This gives us a great strategic outline of their 5 main priorities right now. First up, they're continuing to grow while investing heavily in products, technology, and AI-enabled capabilities to really drive cost efficiencies. Second, they are laser-focused on further reducing parent debt. In fact, they expect to repay over $100 million of parent recourse debt in 2026, and they're aiming to exit the year with a ratio of less than 2 times recourse debt to their last 12 months of cash generation. Third, like we touched on earlier, they're pouring $50 to $100 million into safe harbor activities to maximize those future ITCs. Fourth, simply maintaining that fortress of a balance sheet. And fifth, evaluating sustainable returns of capital, which, could eventually include stock repurchases down the line.
Moving right along to our next section, strong financing partnerships.
You know, a company's balance sheet is really only as strong as the folks willing to back it. And this immense market backing is incredibly validating for Sunrun. Partnering with absolute titans of Wall Street like BlackRock, Goldman Sachs, JP Morgan, and Barings, Sunrun secured roughly $2.7 billion in new tax equity commitments and term sheets in 2025 alone. Plus, they've already locked down an additional $1.1 billion year-to-date. On top of all of that, they raised roughly $2.8 billion in non-recourse project debt last year. Honestly, having the heavyweights of Wall Street continuously fund your originations is the ultimate stamp of approval for your business model's risk profile.
All right, let's pivot to the future. Section 4, Full Year 2026 Outlook.
Looking ahead to the second quarter, they are expecting aggregate subscriber value to land somewhere between $1.1 and $1.2 billion. Now, this reflects a very deliberate strategic mix shift. They're actually moving toward more non-retained or partially retained subscribers. While that does lower the immediate top-line volume metric, as we saw earlier, it keeps their underlying unit economics incredibly strong. And for the full year 2026, they are projecting a very solid $4.8 to $5.2 billion in aggregate subscriber value. So despite a sluggish first quarter, leadership is remaining highly optimistic, and for good reason. They believe Sunrun is perfectly positioned to capitalize on ongoing industry changes, and the truth is, the macroeconomic tailwinds are blowing firmly at their back right now. Utility rates are continuing to rise across the board, grid instability is unfortunately becoming way more common, and as Mary Powell noted here, the underlying consumer interest remains incredibly strong for affordable, reliable power, which of course is exactly what their solar and storage products are designed to provide.
Which brings us to the ultimate question as we wrap up this explainer. I really want to leave you with this final thought to ponder. When you consider their massive $3.7 billion in contracted earning assets, their strategic pivot toward high-margin products, and that aggressive parent debt reduction plan, are these seemingly light Q1 numbers just a seasonal stepping stone to a completely dominant, cash-generating 2026? All the hard data we've unpacked today certainly suggest they are building a veritable fortress of long-term value. Thanks so much for joining me on this deep dive, and definitely keep a close eye on how that project financing officially shifts into Q2.